if you had $400,000, I could show you how to not spend it on this car, still have the car, and own the car for free. You take the $400,000, you take a little risk, and you invest it in a REIT. Starwood Capital's paying 10% on your money. You invest in Starwood Capital, and then the money that you're getting for the $400,000 from Starwood will easily make your car payment and pay your insurance. And you still got the money, and now you got the car.
Can we do it with this car?
No.
Ben Mallah really knows what he's talking about, because if you're someone that seeks a lot of high dividend income or a high yield, you can invest in a REIT or a real estate investment trust, and by law, these companies have to pay out 90% of their taxable income in the form of dividends, and if they don't, all they do is pay tax on that money, so it's not that big of a deal. But here's the stock he talked about. This is Starwood Property Trust, and just like he said, they have a dividend yield of basically 10%. It's at 9.62%, and check this out. The price to earnings ratio, the PE ratio, is a 14.39. So at first glance, this is, a great opportunity. And Starwood Property Trust is actually an MREIT. They do a lot of lending, so you can see up here, I just pulled a screenshot from their most recent investor presentation, and we can see their asset breakdown too. So they are a little bit exposed to the office, but that's okay. But I want to show you how the stock has performed, and to be honest, I kind of expected this because they have such a high dividend yield. So over the past 5 years, they're down 14%. But if we scroll out to the max chart, so this actually goes back, they were listed on 2009, they were $19.50, and now today in 2024 they're $19.65. So even though you get the 10% dividend a year, you've really your capital has stayed flat. But since this is a company that has to pay out most of their dividends by law, I think it's fair to look at the chart that reinvests the dividends. So if we look at it from this chart, Starwood Property Trust has actually performed a lot better than the Robinhood chart. It's actually up from the 2019 level if you reinvested the dividends. But we're going to do an analysis on the stock so you can see for yourself if they have a sustainable dividend. So here's their net income that they make every single quarter, and you can see the year-over-year growth rate. So in the most recent quarter, it was actually up 167% from 1 year ago. It was $159 million. And let's see how much their dividend cost. So and they have a 10% dividend yield. So their dividend cost them $152 million. And have they been diluting you? Well, I was going to say no, but in the most recent quarter, it looks like it went from 312 to 330 million shares outstanding. But that's why the dividend cost went up. See that? It went from 150 million to 152 million. But anyway, it cost them $152 million, and I'm pretty sure they can afford that if you average the 4 quarters. Let's actually go look at their free cash flow down here. So it looks like they have one really good quarter where they make $300 million. It's actually, I don't like companies that are inconsistent, but at the end of the day, I think they can still afford the dividend, or else the stock price wouldn't be where it's at today. And here's their dividend history. So their dividend is 48 cents every single quarter, and it's been at 48 cents ever since 2014. So the last time they rose their dividend was 2014. So I kind of understand why they're not raising the dividend, because of the inconsistent numbers. I'm not sure what's the best thing to look at. I'm looking at net income, and I'm looking at the operating cash flow down here. And both of these, either way, this company has a very, very high payout ratio, and I probably would stay away from it. This is the cash interest paid. How much debt does this company have? I'm curious. So, okay, so this is actually good news. Their debt is down 11% year over year. So that's some good news. How much cash do they have? So they have $327 million of cash, but that's after paying off a lot of debt. So let's actually see that. So yeah, they've been paying off a lot of debt. So good for them. They paid off $927 million of debt in the most recent quarter. So that's always good news. So remember how their dividend cost $152 million a quarter? If we look at this last year, like last year ago, they made $150 million plus every single quarter. So they used to easily be able to afford that. But it's like in the past year, their year-over-year comparisons have not been great. Maybe it's because if we look at their balance sheet, last year they had $77 billion of assets, and today they have $66 billion of assets. So like their total amount of assets have been going down. So maybe they're making less net income off that. I'm not really too sure the full story. I haven't looked into it that deep, but I just want to show you the numbers for yourself, and you can make your own decision based off that. This is not financial advice. I'm not telling you to buy or sell it. I actually own another kind of REIT. I own a triple net lease REIT, ticker symbol O. It actually pays monthly, so I get a monthly yield. But I want to tell you another thing about REITs, and that's about how they're taxed. So other normal dividend stocks like Meta right here, even though their dividend's small, they actually pay qualified dividends, which means For me, they're actually taxed at 0% because of my tax bracket. But the REITs like Realty Income and Starwood Property Trust, they actually pay non-qualified dividends, which means it's taxed to your ordinary income tax bracket or short-term capital gains tax. But I also want to do an analysis on Realty Income Stock because I actually own 30 shares of this company, and they're in the S&P 500. They have a market cap of $50 billion, and they have a really nice dividend yield of 5.44%. So that's what I love about them, and they actually have room to raise it. So check this out. In the most recent quarter, they made 89 cents of core FFO. That's the number we actually want to look at. And if we do this 0.263, that's every single month, so we got to actually times that by 3. That's about 79 cents, and they made 89 cents in cash flow per share. If you're like, that's still a high payout ratio, that's because, remember, they have to pay out their dividend by law. Let me actually visualize the number for you. So look, they have $778 million in the most recent quarter, so that's the number they actually pay out the dividend from. So $700 million, and their dividend only cost $639 million. So as we can see, they can easily afford the dividend, and that's right in line with the payout ratio rule. And check this out. Look how they're able to grow their assets. From 1 quarter ago, they went from 57 to 68 billion. So a huge jump up in assets, and they stayed at the same 42% assets to liability ratio. So they're not getting crazily over leveraged to acquire the assets. If you actually go on their investor presentation, they're actually getting wedge deals because they're buying in such bulk when no other REITs have a huge market cap of $50 billion and can do these kind of things. So yeah, that's why I actually own 30 shares of Realty Income here in my Robinhood portfolio. I also own another REIT that I won't go into details on, but it's CubeSmart, ticker symbol Cube, and we own 25 shares of them. It's worth $1,200. Also guys, don't forget to drop a like on the video. It would really help me out a lot. And shout out to Ben Mallah. He was the person in the intro clip. He's a very smart guy. Watch all his videos, love his insights. I just wanted to give a little information about REITs, what they are,